You know that feeling when a friend proudly shows you their perfect credit score, and then a few weeks later casually mentions he's taking 6 weeks off work just because he can? Same group of friends. One of them had the number everyone's told to chase. The other one had something money apps don't even measure. What if the score he was so proud of was never the one that actually sets people free?
For years, I believed a high credit score meant you were good with money. Honestly, most people believe that. The score goes up, you feel responsible, the apps congratulate you, the banks send you offers. Everything about the system is built to reinforce one idea: higher score, better financial life. That sounded true right up until I had lunch with Brandon. Brandon checked his score the way other people check the weather, every few weeks without fail. If it went up 3 points, he'd bring it up. If it dropped 5, he'd spend the next several days trying to figure out why. That afternoon, he pulled out his phone with the kind of smile you give a report card. "Look at this," he said. 823. I was impressed. Most people never see that number. "You know what that means?" Brandon said. "Banks love me." At the time, that sounded like winning. That's how the system teaches you to hear it. Banks trust you, so you get approved, you get better offers, you get higher limits. Brandon started listing them off: pre-approved cards, special financing, exclusive rewards. And for a minute, it genuinely sounded like he'd unlocked some secret level of adulthood. So I started asking questions, mostly out of curiosity. How much did he have saved? He looked away. "Not much." "How much invested?" He shrugged. "Not really anything serious." "How much credit card debt?" "Nothing crazy," he said, which is usually how people describe a number they don't want to say out loud. "How many cards did he actually have?" He paused, counted in his head, and landed on 9. 9. That's the part that made me stop eating. I asked how many of the 9 had annual fees attached. He laughed like the question embarrassed him. "Honestly, I don't remember." So we pulled it up right there at the table. 2 of the cards were carrying a combined $4,100 in balances he'd been rolling for months. 3 more were charging him a total of $380 a year in fees, on cards he barely used. I asked why he kept them. "It's annoying," he admitted, "but I don't want to lose the points." The points! Not the money he was bleeding every year to keep them open. The points. "When's the last time you checked your net worth?" I asked, mostly out of curiosity. Brandon laughed. "Never." "Last time you checked your score?" "Friday." He said it without even connecting it to anything I'd asked him. It wasn't defensive. It was just the honest answer, offered up like it wasn't strange at all. That's when something started to feel backwards. Brandon wasn't asking whether a card helped him. He was asking whether it helped his score. Those sound like the same question. They aren't. And the stranger part was that Brandon had one of the best scores I'd ever seen, attached to a financial life that didn't match it at all. If the score actually measured financial success, that shouldn't be possible. So I went and found Alex, mostly because Alex never talks about his score. Not once, in years of knowing him. And somehow Alex always seemed less stressed about money than Brandon, even though I couldn't point to why. My first guess was income. If Alex was doing better, Alex probably made more money. Simple enough, except it wasn't true. Some years Brandon made more, some years Alex did. And neither of them made enough of a difference to explain what I was seeing. So that theory died fast. Then I figured it had to be luck, an inheritance, a lucky stock, Bitcoin at the right moment, something Brandon had just missed out on. Nope. No inheritance, no lottery ticket, no miracle trade. Nothing like that had happened to either of them. So I landed on the last obvious answer. Alex had to be some kind of financial genius. Spreadsheets, research, a system he'd built over years of study. "So what's your score?" I asked Alex. He thought about it for a second. "I don't know, honestly." Seriously? You don't know your own credit score? I haven't checked it in months. You don't care? Not unless I'm about to borrow money. Silence. That answer sat with me longer than I expected. Alex wasn't dodging the question. He genuinely had no reason to know the answer. Then a few weeks later, Alex mentioned he was taking 6 weeks off to travel. Not because he'd won anything. Not because he'd quit. Just because he could. How are you affording 6 weeks off? I asked. Same way I afford everything else, Alex said. It's just been building on its own for years. Wait, though, that's when it landed. Alex didn't ignore his score out of laziness. He'd built something that made the number irrelevant to him. Somewhere behind that shrug was a system running quietly enough that he genuinely didn't have to check on it. That, building on its own, turned out to be $52,000 in savings and investments, most of which Alex genuinely didn't think about day to day. Out of curiosity, we pulled up his score together, the same way we had with Brandon's fees. 680. Alex looked at it for about 2 seconds and went back to his coffee. I kept thinking about that afterward. Brandon refreshes his score every Friday like it's a ritual. Alex couldn't even be bothered to finish looking at his. Put the two of them side by side. Brandon, $823 and $4,100 in debt he was still rolling. Alex, $680 and $52,000 quietly compounding in the background. Brandon built borrowing power. Alex built walking away power. I wanted more than a quick glance this time, so I called a mortgage broker my family had used years ago and asked her straight up, "What is this number actually measuring?" She pulled the Fair Isaac page up on her monitor and turned the screen toward me. Fair Isaac being the company that built credit scoring in the first place. I stared at the page for a second. Then I actually reread it because I was sure I'd missed something. Savings? Nothing. Investments? Nothing. Net worth? Not mentioned once. I kept scrolling, looking for it. Nothing. Credit scores weren't invented to help people understand their own money. They were invented to help lenders make lending decisions faster. The audience is probably wondering the same thing I was at that point. If the score doesn't measure any of that, then why does everyone tell us to keep it high? That's when I realized people weren't wrong about that. They were just incomplete. You should have a good credit score. It genuinely helps. A lower rate on a mortgage, a car loan, sometimes even an insurance premium. That part is real. The mistake isn't wanting a good score. It's confusing a good score with a good financial life. I thought that solved it. The score isn't measuring wealth. It's measuring trust to lenders. Clean answer, case closed. Except it still didn't explain why it mattered so much to Brandon that he'd pay $380 a year to protect it. A number that only benefits the lender shouldn't be worth that to the person carrying the debt. Something else was going on, and it wasn't math. It was what the number had started to mean to him. Here's where I landed. There are 2 scores running at the same time, and almost nobody separates them. One is the lender score, the one the bank calculates that decides whether you get to borrow more. The other is the freedom score, and no app calculates it for you. Nobody sends an alert when it goes up. It's just the honest answer to a harder question. How many of your choices are still actually yours? Could you leave a job you hated? Could you take 6 weeks off? Could you say no to something without doing the math first? The system had spent years quietly rewarding one side of that. Pay on time. Keep a card open. Keep borrowing. Get applauded with 3 digits going up. Save aggressively. Invest patiently. Actually own something outright instead of owing on it. The score doesn't move an inch. It was never built to notice that, so it never will. Brandon had maxed out the lender score and never once checked the other one. Alex had barely touched the first and had been quietly building the second for years. Once I actually understood what the score was and wasn't measuring, I still had a handful of practical questions. the kind anyone finding this out for the first time would have. What actually moves the number? Mostly one thing: whether you pay on time, which the broker said carries the most weight of anything in the formula. After that, it's how much of your available credit you're using at any given moment, then how long you've held accounts open, then smaller slices for the mix of credit types and how much new credit you've opened recently. None of it, again, has anything to do with what you own. Should you close old cards? Generally, no. And this is where Brandon's instinct wasn't wrong, just applied to everything instead of the one or two cards that actually deserved it. Closing an old account can shorten your average account age and shrink your total available credit, both of which can nudge the utilization piece the wrong way. If a card isn't earning its keep, downgrading it to a no-fee version is usually the better move than closing it outright. Should you pay annual fees? Only if you can actually name what you're getting back for it, the cash back, the travel value, the specific perk, and it adds up to more than the fee. If you can't name it, that's usually the sign you're paying to protect the number. Not because the card is doing anything for you. That's the exact test 3 of Brandon's 9 cards failed. When does the score actually matter? A handful of real moments: a mortgage, a car loan, sometimes an apartment lease, sometimes an insurance premium, sometimes a background check for a new job. Outside of those specific moments, it's mostly sitting there doing nothing, while everyone keeps checking it like it's doing something every day. Here's the part that actually reframed the whole thing for me. Somewhere around the mid-700s, most lenders are already offering their best available rate. The distance between a 760 and an 823 barely moves anything real. Brandon wasn't protecting a number that was still doing work for him. He was protecting margin that had already stopped mattering, at $900 a month in minimum payments to prove it. I'd like to say I only saw this in Brandon. I didn't. Once I started looking, I found the same pattern in my own decisions. Accounts I'd kept open I didn't need, purchases timed around a fee I was afraid of, checking my score more often than I checked what I actually had left at the end of the month. Nothing as extreme as Brandon's 9 cards, enough to notice. So I stopped treating approval like progress. A lender saying yes to more debt was never proof I was winning. It was proof I was predictable. And predictable isn't the same thing as free. The more I sat with it, the less this looked like a math problem. Brandon wasn't really paying $380 a year to keep 4 credit cards open. He was paying it to protect an identity. The version of himself that got to say "banks love me" out loud at a table. Once a number becomes part of who you think you are, logic doesn't stand much of a chance against it. Brandon still checks his score every Friday. It's the same 3 digits telling him the same thing, and some part of him still finds that worth checking. Nobody has ever sent Alex a notification congratulating him for his net worth going up. Nobody applauds when his investments quietly compound, or when another 6 weeks of freedom stack up in the background where he isn't watching. The system that built Brandon's score was never designed to measure Alex's life. It was never trying to. Here's the strange part. If your freedom score doubles this year, no app is going to tell you. No confetti, no notification, no badge. Nobody will know. Not your bank, not your phone, nobody. Nobody's ever going to congratulate you when your freedom score goes up. You'll just wake up one day and realize you can say no.